Hello everyone, thank you for the time to given to us. We are from 14.1 to present our topic asset management. Before that, we are want to introduce ourselves. First, my name is Maria Claudia Angelica as moderator and first presenter.
Hi, my name is Riton Kajajade as second presenter.
My name is Devliangela Varnia Devi. I am presenter 3.
Hello, introduce myself. My name is Putra Jeremy Ado as for presenter.
Hello, my name is Tade Rosyani Lobo as I last presenter.
Okay guys, we'll start our topic. What is asset management? Asset management refers to the process of strategically managing a company's or individual asset to maximize their value and achieve specific financial goals. Asset can include various from such as cash, stocks, bonds, real estate, commodities, and other investment. Asset management involves making informed decisions on acquiring, operating, maintaining, and disposing of assets to generate optimal returns while managing risk. Asset management refers to the professional management of assets such as stock, bonds, real estate, and other investment on behalf of individual companies and institutions. Asset managers are responsible for making investment decisions on behalf of their clients with the object of maximizing returns and while minimizing risk. Asset management involves making investment decisions based on financial analysis, market research, and an understanding of economic trends. Asset managers typically work with clients to develop specific investment strategies that are aligned with their financial goals, risk tolerance, and investment horizon.
Definition of asset management have wide and variable scope, covering a variety of areas including general management, operation and production, and financial and human aspects. There are 5 different types of assets in any organization ranging from human asset, information asset, financial asset, and intangible asset. The cycle asset represent only one of these broad categories of asset types that have to be managed holistically in order to achieve the organizational strategy plan. Upcycle asset in reconnaissance as any item owned for long-term and short-term use. In economic activities for an organization, this asset can be any item for the organization and it can be of tangible or intangible. In past, the importance of asset management were not properly recognized and applied in many organizations, but recently it has become of great value as the cycle asset represent as important factor in the whole asset management process. The Institute of Asset Management, with a collaboration with the British Standard Institution and various other organizations, had introduced a standard specification for asset management which is known publicly. Available specification 55, it proves An overview on what needs to be done to manage cycle asset for business objective at any point in the life cycle. The main principal objective of asset management is to enable an organization to meet its objective efficiently and effectively. Effective asset management could be achieved by ensuring the real service potential of assets are appropriately used, maintained. In contrast with this, efficient AM should always seek the continuous upgrade and improvement of asset utilization, performance, and feasibility in short-term and long-term basis. The Institute of Asset Management, with a collaboration with the British Standard Institution and various other organizations, it introduced a standard specification for asset management, which is known as publicly available specification 55. It provides an overview on what needs to be done to manage cycle asset for business objective at many points in its life cycle. PAS 55 was first published in 2004 and subsequently revised in 2008. It has been very widely adopted around the world with the great success as the tool for integrating and improving business practice, raising performance, and assuring greater consistency and transparency. The main scope of PAS 55 is the management of cycle asset, but it can also be used to manage different class of asset. PAS 55 was first published in 2004 and subsequently revised in 2008. It has been very widely adopted around the world with great success as a tool for integrating and improving business practice, raising performance, and assuring greater consistency and transparency. The main scope of PAS 55 is the management of cycle asset, but it can also be used to manage different class of asset. PAS 55 is well recognized as it is core function in to achieve a successful asset management, optimal management of cycle asset, which are also involves managing people, information, finance, and other assets.
The successful asset management strategies mainly aim to achieve specific physical asset management activities within given period of time. The strategies are defined as the way and direction of an organization through its configuration of resource within a challenging environment to meet the needs of markets and to fulfill stakeholders' expectations. When completing a strategy and assessment of the current state of the organization is required in order to assess its improvement potential. An organization's long-term plan aligned together with the requirements of maintenance are required to develop a successful management strategy. Such a strategy will be applied to the entire organization division and not only the maintenance sector. PAS 55 definite the physical asset management strategies contest the plan to achieve sustainable level of asset management for long term to asset the organizational strategies plans. One of the main challenges faced in the process of developing PAM strategy is to create and maintain a clear line of sight, which is very important to achieve successful operations. The strategies should be aligned with the PAM policy and should carry the requirements and objectives original in the policy throughout all organizational levels down to the very last operator. This shows the importance of such a strategy in strive for excellence or presence. It is those the strategies are of great value to all these activities as long as it is practiced efficiently and efficiently. Asset management refers to the practice of managing and optimizing an organization's asset to achieve specific objective such as maximizing returns, minimizing risks, and ensuring the efficient use of the resources. Various basic strategies are employed in asset management depending on the organization's goals, risk tolerance, and investment preference. Investment preference. Here are some commonly used strategies. Point 1. Point 1. Activities management. These strategies involve actively buying, selling, and trading asset in an attempt to outperform the market and generate higher returns. Activities management after conduct in-depth research, analysis, and forecasting to identify mispriced securities or market trends. Point 2. Point 2. Passive management. In contrast to active management, passive management aims to replicate the performance of a specific market index or benchmark. This strategy typically involves investing in a diversified portfolio of assets that mirror the composition of the chosen index. Passive management is often associated with lower cost and is commonly implemented through index funds or exchange traded funds. Point 3. Point 3. Value investing. This strategy involves seeking undervalue assets that are trading below their intrinsic value. Value investor analyzes financial statements, company financials, and market conditions to identify assets that have the potential for long-term growth. The goal is to buy assets at a discount and hold them until their value is recognized by the market. Point 4. Point 4. Growth investing. Growth investor focus on identifying assets of companies or industries with strong growth potential. The strategy involves investing in assets that exhibit high earnings growth rates, innovative business models, and expanding prospects. Growth investors are willing to pay a premium for assets that they believe will deliver substantial returns over time. Point 5. Point 5. Income investing. The strategy aims to generate a steady stream of income by investing in assets that pay regular dividends, interest, or rental income. Income-oriented investors often favor stable assets such as dividend-paying stocks, bonds, real estate, investment trusts, or fixed income securities. The primary objective is to generate a consistent cash flow. Point 6. Point 6. Tactical asset allocation. The strategy involves adjusting the allocation of asset based on short-term market conditions or economic forecast. Tactical asset allocation aims to capitalize on market opportunities or mitigate risk by dynamically shifting the allocation of assets between different asset classes or sector. Point 7. Point 7. Strategy asset allocation. Strategy asset allocation focus on establishing a long-term target asset mix based to an on an investor risk tolerance, investment horizon, and um, financial financial goals. This strategy involves diversifying assets across various classes, such as stocks, bonds, cash, and alternative investment to achieve a balance between risk and reward.
Asset management. The of asset in private and public companies can differ based of several factors including their ownership, stock, regulatory and investment objectives are some key for asset management private and public companies. A. Private companies. 1. Ownership structured private companies are typical owned by a small group of individuals such as founders, family members, or private equity investor. Asset in private companies of involves decisions made by the company or management team, taking into account their specific goals, risks, and liquidity needs. Number 2. Long-term growth. Private companies are focused on long-term growth and flow asset strategies might improve profits back info the be to fund and development or the of asset in private can be more in the core or industry where they operate. Number 3. Liquid investment. Private companies may apportion or the asset to liquid investment, sub-private equity, future capital, or real they are long holding per and are known in public markets. Liquid investment can provide potential but may also present liquidity risks. Number 4. Risk management. Private companies have a high risk tolerance compared to public companies as they are not subject to the same security and reporting. Asset may influence and higher to risk investment such as early stage futures of emerging markets inputs of the potential high returns. B. Public companies. Number 1. Public companies have a broad depth of and are subject to regulations and regarding asset consultant with professional asset management or investment contacts. Number 2. Market-based investment. Public companies often a significant part of their asset to public securities are stock and both asset strategies aim to optimize risk trade-off and may involve different across various asset class, sectors, and geographic and regions. Number 3. Regular compliance. Public companies must comply with regular frameworks, such and returns accounting standards and rules as need to consume their regulations as well as the company features leads to its sellers. Number 4. Investor relations. Public and need to their asset and performs to investor Third, financial reports is a calls and investors present asset allows the council align with the company's strategies, goals, and transparent to maintain investor coordination. Thank you.
Investment objectives and risk tolerance of their clients when making investment decisions. Fund specific regulation asset managers overseeing investment funds such mutual funds or hedge funds are subject to additional regulation specific to 2014. This regulation might include risk and investment strategies, liquidity requirement, and reporting obligation. Market regulation asset managers are subject to market regulation that aim to ensure fair and efficient markets. Thus, regulation might include restriction on insider trading, market manipulation, and of non-public information data. Privacy and security asset managers must accompany with data privacy. Privacy regulation and implements operate measures to safeguard silent information. This may include obtaining silent consent for data collection and processing, implement noting data security protocol, and adhering to data breach notification regulations. Marks. Investment portfolio asset management encompasses the professional management of investment and other assets to advance financial goals, while investment involves allocating funds into various assets with the aim of generation. Large asset management include the development and implement of an investment strategy. These strategies outlines the objective, risk tolerance, and investment goals. The invest funds into various assets. The investment strategy considers factors such expense, runs, risks, levels, difference, and market condition. Global index portfolio attracts the attention of investors because the profit differentiation benefits in terms of geographical and financial securities that single quantity-based domestic portfolios cannot profit. Global index portfolios are also of interest to investors because they can capture in aggregate the performance of the entire stock markets in the current world of globalization. Global index portfolios widen that portfolio differentiation horizon to individual and institutional investors by offering a wide array of international exchange investment opportunities that can vary.
The conclusion of this topic is asset management is the process and managing a company's asset to maximize their value and profitability. It involves a wide range of activities, including asset acquisition, maintenance, disposal, and accounting. Effective asset management requires a true understanding of an organization asset, including their value, condition, and performance. In companies should pay attention to the factors that influence their financial performance, such lowering the capital structure value to increase financial performance to the utmost extent possible. For investor, the result of the study can be considering for investing the capital. Research suggests an investor can pay attention to the low capital structure so the company's value become large and good condition. This is based on the study result. The capital structure affect financial performance so that potential investor can consider it making decision. Overall, asset management is essential component of any successful business. Asset enables companies to maximize their research and achieve their financial objective by developing and implementing effective asset management strategies. Business can improve their efficiency, reduce their costs, and enhance their profitability. Okay guys, that's all from us. Thank you for watching and see you next video. And don't forget to like and ask your question and comment below. Thank you. Bye guys.
Invincible, and she's in the background, and she's so